We'll talk more individual names, but let's get a broader flavor and idea of what's happening out there in the market. Mihir Vora is with us in the studios now, Chief Investment Officer at Trust Mutual Fund. Mihir, good to have you with us here. Good morning.
Good morning.
So, price-wise, is a bottom in. What's your sense?
I hope so. I think so. We've had a lot of pain, and the small cap index, for example, was down by 25%. But before we realize it, it's almost up by 8 to 10% from the bottom. So markets, correct very sharply. The rises are probably a bit more, measured. But you got to do what you got to do.
Stay as an elevator.
Stick to your convictions.
So where are those convictions now, Mihir? And has anything changed in this 5-month long sort of recession? Not recession. What am I saying? Correction. Imagine that. That's how the mind works, right? When you hear so much of negativity, recession, correction, all the words kind of mix up. But they also say that every time you have a new phase of a bull market, if at all we're entering one, the leaders are different. So in terms of your conviction, what has changed and what remains the same?
Sure. So just like to spend a minute on, what happened exactly. The point is that part of the correction was justified by valuations. Part of the correction was justified because of slowing fundamentals. And we probably took a little longer to realize how sharply the government, cut down on spending in the first half of the financial year, right? So the government spending, especially the capital expenditure part, it was much sharper. The cut was much sharper than expected, which impacted stock prices, in those segments the maximum. Second is the RBI also kept things tight. And third is the dollar, right? Now, I think all these cyclical factors are coming to a positive territory, I would say. And if you step back and think, now in the June 25 quarter and the September 25 quarter, we actually have a much lower base to start from.
Earnings
as well as top line. Even if government spending comes back to normal levels, you have almost a 20% YOY increase in Capex in the June quarter and the September quarters coming up. So we have a good favorable base effect in valuations. We have a good favorable base effect in top line as well as bottom line. So I think the next couple of quarters, you can actually see good numbers on a year-on-year basis. And then if the momentum sustains, then you actually have good momentum even without a low base.
So from an investment standpoint, the obvious question is that should you now look at aggressively buying or should you look at selectively buying? And if yes, for aggression, what sectors? If yes, for selection and capital protection, what sectors?
Sure. I think the sector that needs to drive the market has to be financials.
Yes.
Because we've discussed so many times that the valuation equation as well as the growth equation seems to be in favor. And balance sheets for most of the large NBFCs and banks are pretty clean. So if we are on the back on the growth path, then I think financials should lead the pack, so to say, especially in the large cap and the diversified indices. In the small cap and mid cap indices, the financials weightage is much lesser, but they will drive the diversified and the broader indices.
Anything that you specifically bought, not necessarily in financials, but in this big correction that we saw? You said that small cap index before you blink was up 8% from the lows as well.
Correct.
Did you benefit from any of those declines?
I mean, we don't take big cash calls, frankly. So we were, anywhere between 90 to 92% invested in any case. So there was not much churn that we did. But in the diversified fund, we did increase exposure to the financials, both NBFCs as well as banks. But we are still sticking to the larger ones.
Okay, so larger financials.
Yes.
That's one aspect. Coming back to and since you're saying that now, you explained the base factor, right? That government spends anyway will start looking better because of the base factor. What is your stance now on the Capex side of the market? That was the previous leader, which is why I come back to that question, saying will previous leaders continue in this phase or will they kind of give way to someone new?
I think they will continue because this story that we talk about is a multi-year story. It's not about only this quarter or next quarter. The government has to spend. The private sector has to come in. The government is rolling out PLIs. We have to indigenize defense production. So all those themes have not changed. We need massive investments in distribution for power generation because of the thrust towards renewables. Renewables targets are being scaled up. So all those themes were multi-year themes to start with, and they will continue. And stock prices are down like 40 to 60% in many of these segments. So I think that will definitely continue. Probably financials, which lagged almost for 1.5 to 2 years, should now not lag that much and actually maybe lead the pack a bit. Okay. So maybe the kind of multi-bagger returns that you saw between 22 to 24 in some of these segments, the Capex segments, may not be there because even after correction, they are at normal valuations, but you will still see them outperforming.
Earlier, up move was expected to be Capex-led, and now post the budget, people are talking about consumption. There is a recovery in rural consumption. There is expected recovery in urban consumption. Where do you stand in the consumer stocks?
I think FMCG will continue to underperform. I mean, it may do better than what it itself used to do, but it's still a boring number.
Okay.
Because most of these categories are well penetrated, 80-90% penetrated. And I was just looking at one of the studies that Motilal Oswal did on the institutional equity side. Most of the large cap FMCG stocks have less than 10% CAGR in turnover over the last 10 years, right? So even if you remove all the seasonality and cyclicality, we are talking about, maybe single digit or low double digit kind of a growth number, which is not what we want in our portfolio.
Okay.
No, got that. By the way, Mihir, with full disclosure, and of course not asking, would you want to name one or two, I mean, a few ideas in the small and mid-cap space where price damage has been quite a bit. How are you thinking about, what kind of framework are you building to when you look at names, businesses? Because just simply price damage cannot be it, right?
Absolutely.
So just to give us a sense, maybe, one name and just to kind of sort of build the thesis around it.
Sure, name is not possible, but we have always been saying that the domestic economy makes more sense to play than the global economy. And we have been mostly underweight on large cap IT stocks, for example, and we've been mostly bullish on the domestic themes. Within the domestic themes, as I said, we were kind of underweight on the financials till now, more on the Capex and physical asset creation side. So that means capital goods, infrastructure, construction, railways, defense, those kind of themes, which we continue to be overweight on. And then specific stock picking in the healthcare segment. So within healthcare also we have generics, we have CDMO, we have the hospitals, and we also have the diagnostic plays. So across healthcare also we are overweight. So we are structurally overweight on industrials and the physical asset creation, including real estate. We are structurally positive on the healthcare segment typically. That's what we tend to do. But now incrementally, as I said, I would play more of the domestic financials.
When you speak about real estate, incrementally, we've seen an up move come by on Aditya Birla Real Estate. Remember, the company has launched a project, their first project in Pune, eponymously named Punya, Aditya Birla Punya, and they expect sales in that business to come to around 2,700 crore rupees. So AB Real Estate up 4%, the street takes note of that. On real estate specifically, where in the cycle do you think we are? Because at one point the prices were going extremely high. This is flat prices that we're talking about. Now, there are pockets of problems in the entry and mid space, whereas luxury continues to do okay-ish. Where do you think we are on the real estate space, and what sectors would you back? Would it be Bangalore, Hyderabad, Bombay or Delhi?
In real estate, I would not really play for price appreciation anymore in most of the market segments, because we have seen good price appreciation in the last 3 years in most of the segments. But volume growth, especially for the organized players, I don't see a problem. Because even now when quality builders are launching projects, they are getting lapped up. There might be a bit of a froth in the NCR market, especially the Gurgaon, where, things are a bit wonky. I don't know how much is, bookings and how much is genuine sales there. But in general, I think volume growth is something that we need to play for. And as you mentioned, the affordable housing still needs a bit more push, I guess. It's not the strongest segment. We still continue to be in the K-shape of the real estate space.
You mentioned financials. I just want to come back to that. By the way, just let's pull up the stocks as well. Bajaj Finserv, and I think in finance, they have now turned slightly lower. That's the situation. Look at the other life insurance stocks as well. Pru, Lombard, there's some green over there. SBI Life also started out positive. Let's talk about the non-banks, because you're positive on overall financials and what makes sense to you over here. With insurance, the thing is that there are so many regulatory changes. Every quarter you run into something from IRDAI or something on taxation, which kind of, truncates the wider move. But we know there's commitment in this deal. This morning's deal tells us that there is serious money being put to work over here. What do you like in non-banks?
So in non-banks, we've recently, not recently, we've basically always been positive on the capital markets theme.
Okay.
Of course, that theme has taken a beating for lots of reasons. First of all, in some of the exchanges, etc., because of regulatory changes, volumes have come down and all that. So we have seen stock prices take a beating. But now they've, I think, formed a good base in any case. So structurally, in the capital markets theme, because we think the savings pool will continue to increase. So everything linked to the savings pool, which is wealth management, broking, asset management, and then of course you have more trading, etc., exchanges, etc., mutual fund distributors, for example, they'll continue to do well. They will continue to grow at a rate which is faster than the rest of the financials. So structurally, I think the capital market segment will grow even faster than the lenders.
And the vagaries of the market don't worry you, because typically the sentiment is that
they will be,
the stocks will fall every time the market falls.
They will be pro-cyclical.
Yeah.
They'll be high beta in the direction of the market. But point to point, if I were to take a 10-year view, I think they will
overall
outperform.
it will give you
Yes.
better returns. And what about lenders? You're saying some of these, the capital market plays will outperform, let's say, lenders.
Over the longer term, but they'll be high beta.
But in lenders, because it's not a, paint everybody with one brush situation anymore.
Correct.
So what is governing your stock picking when it comes to banks?
Absolutely. So as I said, in the lenders, I'm bullish both on the NBFCs as well as the banks. NBFCs probably in the shorter term might benefit more by the rate cut cycle, because most of the NBFC lending is fixed rate, again, as compared to the banks, which is floating rate. So when rate cuts happen, the bank's asset book will get repriced faster downwards. The liability book will take a little while to, so they might not be able to improve their margins immediately. But NBFCs, because their borrowing costs can come down sharply immediately, they can improve their margins in the shorter term. And plus, the RBI had been really coming down heavily on the NBFCs last year, which they are now easing.
They have some reprieve over
So they have a
there.
regulatory, bit of a regulatory tailwind also.
What about hospitality? We've been speaking about, that being in a cyclical uptrend, also demand-supply dynamics favoring the industry, unorganized to organized, and all FMCG, yes, under-penetrated, but consumer discretionary doing a lot better, and hospitality is one of those spaces.
Absolutely. So, the K-shape continues in the economy. While rural is catching up, I think as far as growth rates are concerned, all the premium segments will continue to, whether it's hospitality or airlines or, hotels or even your high-end jewelry, for example, watches, high-end cars, SUVs versus cars. So that, I think, theme will continue.
Mihir, pleasure having you with us here. Thank you very much for joining us.